Good morning. Welcome to CurrencyChange Daily Markets Update on Friday, the 23rd of August 2013. The global economy showed signs of improvement yesterday, with factory output improving in China and Europe. Trading was halted, unfortunately, for 3 hours yesterday night on the Nasdaq due to a connectivity issue, but US markets closed higher despite this problem. In the US, the dollar advanced to a 2-week high against yen as initial jobless claims over the past months in the US fell to a 5-year low, boosting the case for Federal Reserve to reduce stimulus in September. An index of US houses prices climbed 0.7% in June from a revised 0.8% gain the previous month, according to Federal Housing Finance Agency. And another leading indicators, the Conference Board leading economic indicators, increased 0.6% in July. These leading indicators confirm the fact that the outlook for gradual improvement in the US economy is on track. US registered bond, mutual exchange and exchange traded funds, they lost $30.3 billion to investor redemptions this month, putting them on track for the slowest year, meaning people are pulling out their money from bonds at the moment, expecting QE to stop. In the Eurozone flash PMI rose to 51.7 in August, very good news for Europe, from 50.5, beating all estimates. It was the best reading since June 2011. The PMI data from Germany jumped to 53.4 in August versus 52.1 in July, but French PMI data disappointed strongly yesterday. Might be linked to August, where during this month things are not happening. In Germany, the German Finance Minister Schäuble clarified statements earlier in the week regarding Greece, where to assure people the government was not hiding bad news ahead of elections, and they will support Greece no matter what happens. In the UK, PMI services now points to growth of around 0.7% in Q3, which could pose some upside risk to forecast, with the service sector making up to 78% of the UK economy. The second reading of UK Q2 GDP will be released this morning and could see an upward revision due to better than expected data from construction and services sector. In Asia, a consequence of the end of QE could be a progressive outflow of money from emerging countries, particularly when the US short-term part of the yield curve will strengthen, obliging portfolio managers to bring back their money in the country. Central banks in emerging markets have lost $81 billion of emergency reserves through capital outflows and currency interventions since May. In India, the rupee is at a historical low against the dollar, down 17% this year, and the 10-year government bond yield touched 9.24% yesterday, and the country could be downgraded. In terms of exchange rate, we are currently live on sterling dollar at 1.5580, on sterling euro 1.1675 stable, sterling Aussie 173.10, sterling New Zealand 199.25. Sterling dollar is currently trending in a range 155.20 to 166.50, and so does sterling euro. The market is sensing that Mr. Carney will continue to talk long-term UK rate down as he tries to manage future UK economic growth. Euro sterling showed a slight rebound since yesterday, touching the 10 daily moving average support on strength that early rate hikes dissipate. Sterling CAD is at a 1-year high low. Feel free to contact us if you're interested. German GDP was released this morning in line with expectation, no revision upwards. At 9:30 UK time, we have the Q2 GDP second release, expected 0.6% versus minus 0.3% in Q1. And at 3 o'clock UK time, US dollar will have new home sales month over month, so no big news in the US economics. If you require further information, visit CurrencyChange.com or contact us on +44 0207 373 2686. Have a nice day.